Assalamualaikum and hi, I'm ERLYNA binti ABDUL. Today, let's talk about factors that influence exchange rate. But before that, did you know what is foreign exchange rate? Foreign exchange rate is a rate at which one currency will be exchanged for another currency and affect trade and the movement of money between countries. Okay, let's move to the first factor, which is inflation and deflation. What is inflation and deflation? Inflation occurs when the price of goods and services increase too much and too quickly, while deflation occurs when those prices decrease. So what it can do? Inflation and deflation can influence exchange rate by affecting country purchasing power, trade competitiveness, and investor confidence. So when inflation goes up, it decreases the value of a currency in two main ways. Firstly, it reduces purchasing power. High inflation makes goods and services more costly in the country, which decreasing the value of the currency. For example, if a loaf of bread in Malaysia costs RM2, but goes up to RM4 because of inflation, the purchasing power of the ringgit decline. Secondly is less competitiveness export. Countries facing high inflation often find that their goods and services are too pricey for buyers from other countries, which leading to lower export demand. Lower export reduce demand for the country currency, which causing it to weak. For example, in 2018, Turkey faced inflation rate over 25%. This high inflation caused the Turkish lira to depreciate rapidly against the US dollars, where many foreign investors decide to leave Turkey, which caused the demand for the lira to decline. So moving on to deflation. Deflation increases the value of money as price drop. This makes a country goods more competitively internationally and boosting export. When the value of money goes up, it will make more buying power. When deflation happens, price drop, which making goods cheaper for both domestic and foreign buyers. This can boost the demand for export and make the currency strong. For example, in the earlier 2000s, Japan experienced deflation, which causes the price of electronics and cars to drop. Because of this, more people around the world wanted to buy Japanese product, which made the yen strong. Next is deflation that can show the economy is stable, where it can attract foreign investors who looking a safe currency to invest their asset. When deflation happens, a currency might seem undervalued or less risky, making it attractive to international investors. As I mentioned before, the early 2000s, Japanese experienced a deflation period. The Japanese yen became more strong because international investors view it as stable currency and secure option for them to invest their asset. Next, I will pass to the next presenter.
Hi, my name is NURUL binti ABDUL. So moving on to the one of the most influential factors in foreign exchange markets, which is the interest rates. So this rate is set by central banks and play a vital role in determining the value of currencies in worldwide. So what are interest rates? So the interest rate are the cost of borrowing money or reward for saving. It is set by a country's central banks. So they play a crucial role in the economy, influencing inflation, growth, and even the currency's value. So let's break it down. When increase in interest rate will also increase the value of currency. It is because a higher interest rate will provide a higher rate to lender. So as a result, people from other countries will invest in the country where interest rate very higher and will increase in demand for currencies and therefore its value, causing it to appreciate. This will lead to foreign exchange fluctuation. The impact for higher rates is mitigated, however, if inflation in the country is much higher than in others, or if additional factors drive the currency down, the opposite relationship exists for decreasing interest rate. That is, lower interest rate tend to decrease exchange rates. So, when rates are low, investors may move their capital elsewhere for better returns and reducing the currency demand and depreciating its value. I give you an example. In 2022, when the US Federal Reserve raised interest rate to combat inflation, the US dollar strengthened significantly and investors flocked to US assets, boosting the dollar's value against other currencies like the euro and yen. Interest rate also drive a strategy called carry trade. Investors borrow in a currency with low interest rate and invest in one with high rates, benefiting from the interest rate differential. This further impact demands and exchange rates. To sum up, interest rates are a powerful tool in influencing foreign exchange market. By understanding their impact, we can better navigate the complexity of global finance.
Let's talk about how the trade balance, the difference between a country export and import, influence exchange rate. The trade balance play a vital role in determining the value of a country currency. When a country export more than import, it creates a trade surplus. In this case, foreign buyers need the country currency to pay for goods and services. This increases demand strain the currency, causing it to appreciate. On the other hand, when a country import more than export, it results in a trade deficit. To pay for this import, the country need more foreign currency. This increases the supply of own currency in the global market, leading to depreciate. For example, each country like Japan export high-value goods like car and electronic. Its trade surplus support a strong yen. Conversely, if a nation relies heavily on import like oil and machinery, its currency may weak over time. It also important to note the trade policy and global commodity price impact this balance. A weaker currency can make export cheaper and more competitive, while a stronger currency might make import more affordable. In summary, the trade balance reflects the health of a nation's economy and significant effect its currency strength. A stable trade balance is key to maintaining a stable exchange rate.
So next, we're gonna go through the government control, which is the factor influencing the exchange rate. First, we're gonna show the red regions, which is the government chose the exchange rate that are managed. There have three. First is field regions, which is the currency value is the pigeon with another currency or asset. The second one, the floating regions is currency value is determined by the market, and the last one, manage a flow, which is a mix of both casually government intervention. So the next is monetary policies, which is the central banks have to control the interest and the money supply to influence the inflations and economic growth. This action directly impact the value of the currency to the country. And the number 3 is a foreign exchange intervention market, which is the government or the central banks have to buy or sell their currency in their foreign market to stabilize or manipulate their value. And number 4 is capital control restricting on foreign investment or flow in or out of the country can be influenced currency supply and demand. And number 5, trade policies. Trade policies like tariff, costs, and subsidies affect the trade balance, which is in turn impact the exchange rate. For example, a trade supplier strains the currency. And number 6 is political established and economic policies, which is the political and the self-economy manage build the investor confidence and attracting the foreign investment and strengthening the currency instability weak in. And the last one is deep and reverse management, which is a high in national debate can discord in foreign investment weakening the currency. And that's the largest of foreign currency reverse and enable the government to stabilize the exchange rate during economic shocks. This is a factor that shows the government influence the change rate through the politics and their control.
Moving on, my name is SAFIKA BINTI BASARUDDIN, and I will explain about the last factor that influence foreign exchange rate. So the factor is political stability. The definition of political stability is the lack of political unrest, the general trust in a nation's political system, and the consistency and predictability of a government's policies. Economic growth and currency strength depend on investor confidence, which is enhanced by a stable political climate. So, the good economic policies are often associated with a political stability. Generally speaking, stable administrations can carry out long-term economic plans that encourage expansion, manage inflation, and uphold fiscal restraint. These elements have a favorable impact on a currency value. The conclusion about the factors that influence foreign exchange rate is a critical indicator of a nation's economic health. Influenced by various interconnected factors, understanding these factors can provide insight into currency valuation and its implications for trade, investment, and overall economic stability. So that's all from us. Thank you for listening.